Joining us here at Post 9 is Goldman Sachs Chief U.S. Equity Strategist David Kostin, that six handle made a splash earlier in the week. David, are you prioritizing what's most likely here on these different scenarios?
Carl, what's most likely is the market's flat. From here to the end of the year, 5,200. That's the target. It's expectation that you have modest growth in earnings, around 8%, looking into this year and 5% into or 6% into calendar 2025. That's the trajectory of profits. And the valuation, it's really important to break it into two pieces to think about that. Equal-weighted index, SPW, trading at 17 times earnings, which is expensive, almost a 90th percentile. And the premium that the aggregate SPX index trades relative to the equal-weighted index. That trades at 21 times. It's kind of aggregate, about 25% premium, 17 to 25. That dynamic suggests the market is likely to be closer to around 5,200. That is our baseline. Now, we created or thought about some different scenarios, a catch-up, a catch-down scenario. Could be, pretty broad ranges, 4,500 on the lower end, and 6,000 would be on the upper end, to your question earlier. And that would be a scenario that you have the large-cap exceptionalism, mega-cap exceptionalism. Those stocks have multiple increase. That's less probable in our view. Maybe it's a little bit higher. You get some catch up. Maybe it's not 5,200, perhaps 5,800 would be a optimistic scenario, Carl. But I think our general forecast, our framework, what's priced in the market is 5,200.
Are you moving your S&P earnings number?
No. We're right on line with our expectation. Our forecast of around plus 8%, $241 a share. The consensus of the other strategists in the street a little bit lower than that, and the bottom up of all the analysts roughly in line with that. So bottom line, just think of high single-digit kind of earnings growth, and that is pretty much the expectation. If you stand back, you got a couple of four things. You got the economy, you got earnings, you have valuation, you have money flow. What is priced into the market? The equity market today prices as though the U.S. economy is growing at 4%. It's not growing at 4%, but equity investors are pricing such. You can look at cyclical stocks relative to defensive stocks. That's the economy. The earnings, as I indicated, high single digit, basically pretty optimistic. Margins, a little bit higher, sales growing. Basically, that's a positive scenario in the backdrop. Valuations high, as we just talked about, not the highest, but it's pretty extended. And the money flow. Where's the money flow coming? It's coming from corporate repurchases. It's coming from households putting a little more money into equities. There's net selling on the part of pension funds, on mutual funds. Those are the stories. That's the framework.
David, do you have a direct negative correlation between where interest rates are, the Fed fund rates, and your S&P target? If we get more cuts, does your target increase? Or actually, we learned in the last couple of years that where the Fed funds rate isn't the key factor?
Well, Alfred, it's an excellent point, because when the market was pricing, three cuts was priced into the market sort of last fall, and then it kind of moved all the way to six cuts, again, forward market pricing. The smaller cap stocks rallied dramatically. And that's this idea of the equal-weighted index, if you will, having a catch-up. So to the extent that there is more cuts than is currently expected right now, that would be a positive for a broadening of the market. To the extent that there are fewer cuts, Goldman Sachs economists expect 3, forward market pricing roughly around that level. If it was 2, then that would be more supportive of larger cap, better balance sheets, more, the mega cap stocks continuing to do better. So that's kind of how I think about your question.